Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on this afternoon's market action. About an hour to go in the trading day. You're looking at stocks well off the highs of the day. The Dow now actually in negative territory. We are seeing yields climb as more traders do bet that we will see the Fed hike rates again in June. Taking a look at some of that action playing out in the bond market, you have the 2-year yield heading toward the highest level that we've seen in about a month. Also, the 10-year yield also pushing to the upside. In terms of what is keeping the market under pressure sector action-wise, we're seeing underperformance in real estate, consumer staples, and healthcare. On the flip side, one of the outperformers today, consumer discretionary communication services, but consumer discretionary, a big story there, Akiko, on the heels of the earnings report that we just got out from Walmart this morning.
Yeah, and we are watching shares there. We saw a big pop for the company with the retail giant reporting better than expected earnings ahead of the open. And it did raise its guidance. You see the stock up more than 1% there. Strength in the grocery business helped offset weakness in clothing and electronics. And like its peers, Walmart says it's seeing signs of a consumer slowdown. Here's what Walmart CFO John Rainey told Yahoo Finance earlier today.
When consumers are coming to our stores, we're seeing trade downs in terms of buying less expensive meats, or instead of buying a pack of 12, they're buying a pack of 6. You can see that their wallets are being stretched more thinly. And when you look broadly, I look at the same economic data that you do, but there are other indicators. We're seeing credit as a funding instrument, as an example, be more elevated to where it was in prior periods. You're seeing delinquency rates on credit cards in general tick up. And so there are these signs that there's some fraying in terms of the consumer health, and we're keeping a cautious outlook on that.
Walmart CFO John Rainey there talking to our morning team about what that consumer looks like for Walmart. Shauna, when you look at the numbers here, strong quarter for Walmart. When you compare it to some of the other retailers, comparable store sales were up more than 7% year on year. I think it's interesting to note what they're seeing in the consumer, though, because it's a little different than what we heard from some of the other retailers. Number one, they talked about how they're seeing sort of the higher income consumer coming in, particularly for groceries, sort of a trade down, you could argue, because of the discounted prices that Walmart has to offer. Also, private brand penetration up 110 basis points. So going for some of these private brands instead of the other brands that we see, that is another sign of a trade down. Overall, though, you could argue when you think about the consumer concerns around inflation, Walmart's a little better positioned, largely because of the mix that they offer with more groceries than some of these other retailers.
Yeah, the grocery results there, Kiko, definitely helping padding these recent results and really showing why Walmart is better positioned in this type of environment. You mentioned the fact that some of those higher income shoppers, more of those people are shopping now at Walmart. And that's something that executives have discussed in recent earnings reports, what they also discussed this morning. And now they want to make it a reason for those higher income shoppers to continue shopping at Walmart. That's one of the challenges that the company has as we look out to the next couple of quarters, just in terms of retaining that new shopper. When you take into account some of the other strong numbers that the company put up, improvement in inventory, something that we certainly saw at Target yesterday. Also, inventory levels at Walmart falling about 7% on a year-over-year basis. And online sales, Akiko, that was up across the board in all the divisions, overall up 27%. And you compare that to Target, which actually saw its online sales fall about 3% in the most recent quarter.
Yeah, and that's really the result of several years of significant investments for Walmart in trying to expand that online presence. One more thing I should note, though, because we've been talking so much about some of these retail names, the mix of what Walmart's seeing among shoppers, a little similar to what we've heard from the likes of Target. They've said grocery, health, and wellness are the big drivers right now. Some of those other discretionary items we've seen consumers holding off on, at least so far.
All right, well, let's talk a little bit more about the state of the consumer and the retail sector at large. For that, we want to bring in Brian Levitt, Invesco Global Market Strategist. Brian, it's great to see you again. So consumers are trading down. We also see people pulling back on their spending moderating a bit. What does this mean then for the market?
It's actually a good sign. I mean, it's sort of paradoxical. If we saw the consumer that was still shopping at a clip that they were shopping in during the early days of COVID or into 2021, it would be far more problematic. Remember, precisely what the Federal Reserve has been trying to do is slow down this economy, in essence, make people feel a little bit less wealthy. they've been successful at that, and as a result, the consumer's moderating and the economy's slowing. But that's precisely what the Federal Reserve needed to do in what was a very high inflation environment.
Yeah, and there are questions about what that next step is from the Fed. But if we bring the conversation back to the consumer, based on the retail earnings we've gotten, the data that we've gotten so far, from an investment standpoint, who do you think is best positioned to ride out this wave right now?
Well, in the near term, you'd want to be a little bit more defensive. And so a company like Walmart that you were talking about, where consumers can come in and take advantage of Walmart's labels or can, take advantage of lower costs. That's where you'd want to be in a more defensive contractionary environment. But what investors should also recognize is that the sector that leads out of the economic soft patch or the recession is consumer discretionary. And so while we're not there yet, typically that happens following policy tightening, a shift in the Fed's approach, where we're not ready to call the recovery and the new economic cycle. We will be there over the next months, and perhaps as early as within 2023. So, investors should start to be thinking ahead about what the peak in inflation, the peak in policy tightening looks like, and think about those cyclical sectors that tend to outperform in the early stages of a news cycle.
Brian, between now and then, though, do you expect some of the pressure that we have seen on consumer discretionary for that story to continue then, at least in the near term?
Yeah, you'll need a cyclical impulse on that. I mean, we're still waiting to see the lagged effects of all of this policy tightening. Now, the economy has been resilient, but we've never historically gotten through this much tightening without a further slowdown. So the near term warrants some caution. But my point is to say that there's another side of this. While you're hitting the guideposts to the end of a cycle, that also suggests that you start looking ahead to what the next cycle will look like.
We've got just under a month to go until the next FOMC meeting. We did get some Fed speak this morning. Dallas Fed President Lori Logan speaking about the upcoming plan, saying, quote, after raising the target range for the federal funds rate at each of the last 10 FOMC meetings, we've made some progress. The data in coming weeks could yet show that it is appropriate to skip a meeting. As of today, though, we aren't there just yet. And specifically, she talked about the core's preferred inflation data, PCE, that coming in a little hotter than expected. Now, we're still looking at the CME Fed probability currently at 64% chance of no hike. Where do you stand on that?
Yeah, I mean, I'm certainly hoping that there's not a rate hike. I would like to see what the lagged effect of all this policy tightening is going to mean on the economy. I mean, these probabilities have not necessarily been right throughout this whole cycle. So it is possible that we could see another rate hike. I mean, look at what the 2-year rate is doing today. The good news, though, is that the move in the 2-year today has not corresponded with a sell-off in the S&P 500. So the market recognizes that, we're either at the end of the tightening cycle or, perhaps another one to go. But this is a market that is gearing up or getting ready for a period of greater policy clarity, something that we haven't had, quite frankly, since the fall of 2021.
Brian, what about if we do get another rate hike in June? What will that do then to some of the regional banks, some of the stress that we've already seen play out within the financials?
Yeah, I mean, it's not great. I mean, the financial accidents that occur at the end of every tightening cycle only tend to end with a shift in policy and the Federal Reserve working to normalize the yield curve, whether they're actually easing or just using the power of the mic to suggest easing in the future. So this is the first instance that I can think of where you've had the financial accident at the end of policy tightening and the Federal Reserve kept raising rates. In all the other instances, the Federal Reserve was easing by now. And so that's a bit of a challenge. It continues to be a challenge for the regional banks. Now, the good news is, the quality of assets on bank balance sheets look quite good. It's really more of the confidence issue, the hold to maturity issue on those quality assets, as we've all been talking about. So this will shift as rates start to come down, as the Fed normalizes the yield curve. I hope we're sooner to that rather than later, but I'm not sure the Fed's answering my phone calls these days.
There's another X factor that's kind of hanging over the market right now, and that is the debate over the debt ceiling. Vice President Kamala Harris speaking today virtually to community leaders about the dangers of a potential debt default. Take a listen to what she had to say, and I'm going to get your reaction on the other side.
A default could trigger a recession, stop military paychecks, and raise interest rates for years to come, and turn mortgage rates into a situation where they would actually go up. Credit card payments would go up, and small business loans would be more expensive. It would also reduce the amount of money in your retirement accounts. So for an average American close to retirement, their 401k could lose over $20,000 hard-earned dollars. And a default would also put at risk programs that millions of Americans rely on, including Social Security and Medicare.
We have seen the administration sort of message this doomsday scenario the closer we get to that X date, which is June 1st, as we know it right now. The market doesn't seem to be reacting significantly to that. How do you, or where do you place the risk of a default in the long list of risks that the market's facing?
I still have it at a low probability. I mean, I always adhere to the words of Winston Churchill, whether or not he said it or not, which is Americans always do the right thing, but only after exhausting all other options. So, this is a negotiation, and we're working through that negotiation right now. I mean, the Biden administration had initially said that they're not going to negotiate. They want a clean increase in the debt ceiling, which was always going to be a non-starter for the House. And now we're in that negotiation phase. Much like the Obama administration in 2011, there's going to have to be something that the Biden administration gives, some type of budget caps or spending reductions over the next 10 years. I believe that this will get done. I'm not surprised to hear the vice president talk about it in such a scary way. I mean, that's obviously to try and garner support from voters and from Americans to ask their representatives to raise the debt ceiling. But ultimately, I would expect, much like in past years, this will pass without incident.
So, Brian, what should investors do right now? Those that are worried about it, should they stay on the sidelines, or are you still seeing some opportunity now?
Yeah, I mean, I wouldn't be sitting on the sideline because of the debt ceiling. I think that, we'll see that hopefully pass without incident within the next week or two. I think what a lot of investors are doing right now is going into money markets, and money markets look very attractive. You can get a yield of 5% with, no real historical volatility. Why wouldn't you want to do that? Well, I would just tell investors to go back and look at any time money markets seemed this attractive. It's happened in times like 82 and 2000, 2006, when you had an inverted yield curve. In actuality, in hindsight, a peak in interest in money markets suggested that you wanted to go longer with regards to bonds because you wanted to lock in the yields. You wanted to start thinking about taking on risk over the next months, because typically a spike in money market assets is a harbinger that the S&P 500 has or will form a bottom. So I think that, the near term, if you're very tactical, the market still says quality, defensive. I'm okay with that. But I'm also a FOMO guy socially and with investing. I don't want to miss out. And I do believe over the next couple of years, which almost always happens after Fed tightening, the markets will do very well.
I can assure you, you're not the only one with FOMO, Brian. Always good to have you on this show. Brian Levitt, Invesco Global Market Strategist. Appreciate the time today.
Thank you.
Well, coming up, we are just getting started here on Yahoo Finance Live. Coming up, executives from the failed bank SVB and Signature were on Capitol Hill this week testifying. Former chair of the FDIC, Sheila Bair, is going to be giving us her take on their testimony. Plus, Montana bans TikTok. We're going to tell you what it means for other social media platforms on the other side. And we're talking all things travel ahead of the summer season with the CEO of Expedia. That's coming up at 4 p.m. Eastern. You won't want to miss that. We'll be right back.
The Supreme Court handed a big win today to Twitter, Google, and a host of online third-party content. Yahoo Finance's Alexis Keenan is here with the details on that. Alexis, largely the Supreme Court leaving Section 230 untouched.
Unscathed. This is a big deal. And this decision, it's unanimous. It comes from the land's highest court. 9-0 decision with Justice Thomas writing it, saying that Section 230 will remain intact. Now, this comes out of one of two very similar cases that kind of ran in tandem. Both of them arise from plaintiffs who said that social media companies, Google, Twitter, Facebook, and the like, that they contributed to terrorist attacks that ended the lives of the victims. These are the families of the victims that brought these cases. They said that the recommendations that their algorithms used to recommend videos and content, that those recommended ISIS videos, and those sympathizers used them to then carry out these attacks. However, the court said that this case that came against Twitter specifically, that these online hosts cannot be held liable merely because the terrorist organizations use them in the same way, use these services in the same way that billions of users use this content. In the opinion, Justice Thomas writes it this way. He says the defendant's recommendation algorithms are merely part of the infrastructure through which all the content on their platforms is filtered. Moreover, the algorithms have been presented as agnostic as to the nature of the content. That seemed to be important here in these arguments. And what this transpires now is that it's really a kind of a dead end for both of these cases. Now, with respect to the secondary case, the court said, hey, Ninth Circuit, we're going to send this back to you. You take a look at this Twitter decision and you come in line with what we're saying here. So because both of these cases are brought on such similar grounds, it looks like the Ninth Circuit is going to have to say, yes, we will abide by this, and that means that Section 230 will remain as it is for now.
Certainly looks like a huge win here for the tech companies. Alexis Keenan, thank you.
Well, the court's decisions today offered a big sigh of relief for some of the big tech platforms, but with lawmakers exploring additional regulation, they may not be out of the woods just yet. Let's bring in Brent Thill, Jefferies senior analyst, to discuss. Brent, I know we've talked about regulation a lot with you as a potential overhang for some of these social media companies over the years, but what do you make of the court's decision today, and what does it ultimately mean for these social media companies and how they operate? Does it free them up in a way?
I think there's a rolling waves of regulation. So I don't know if there's a free up or slowdown. I just say that this is something we've been living with for a while, and it's the number one topic among investors. It's hard to handicap what happens, but ultimately what the playbook says is you own the companies that have the vast number of users and the most data. And that comes down to Meta, Google, Amazon, and those stocks are ripping this year. So I just go back to the simple playbook is the regulatory issues for investors are I don't want to call it a sideshow, but it's effectively, it's not the most important thing. The most important thing right now is the health of the advertising community, what's happening in the economy, ultimately, what are we doing with AI? Those seem to be governing the decisions that we are hearing from our investors. And a regulatory impact is, again, we get occasional hits, but I just say, like, it's really not the core focus of investors right now. It's important. It's important to pay attention to, but I think anyone that followed regulatory too hard and too fast is missed out in a big way, right? We've had this concern that the regulatory issues would have a huge overhang, and these have been incredible money making stories, this year and over the past. In the past, last year obviously was very difficult for all of tech.
Brent, what about when it comes to regulation or the government crackdown, I should say, putting aside the larger U.S. tech giants, we got to talk about TikTok, with Montana banning TikTok, the first state to do so. The implications of that for the social media industry at large, is that viewed as a big win, or could it potentially be viewed as maybe this could be a hurdle for other social media companies down the road, just given the regulation aspect?
I mean, it's a rounding error. When you think of 1 million people in Montana, what percent are on TikTok? I don't know. Let's say it's 30%. I mean, it's just a total rounding error, right? It doesn't matter. What matters is, do other states follow what Montana is doing? and put in more regulation. So that's the bigger concern of the avalanche of other states piling on. So I'm not going to say it's not important. It's something we're watching, but it's right now it's not at a severity level that really anyone cares. If it happens in California or New York, that's a different topic. But right now, again, I love Montana, but it's a total rounding error.
Yeah,
so, I mean, it's just,
Brent,
you're not going to move the needle.
I'm with you. Montana, not the first place we think about with TikTok, but there's a larger question about what the government strategy is. We're talking about a local level right now, but on a national level, is it really about a full-fledged ban for TikTok, or is it about sort of raising questions around a platform so users start to move away? And is that alone effective in trying to shut down a platform? I know you're watching a lot of the ad dollars, for example, watching closely. I mean, are you starting to see any of that activity move away?
No. I mean, look at, Meta's going to benefit. If this continues on TikTok in the US, Meta will benefit, right? Reels is doing very well. That's TikTok's biggest nightmare is can, Meta Reels continue to pick up. So I don't think right now it's hey, TikTok's going to lose and this vendor is going to pick up share. Right now, what we'd say is that Meta and the big platforms are doing really well. Snap has continued to trip on their own shoelaces. Others in the industry, right, aren't doing as well. So I think it's this gravitational pull back to the bigger platforms. They're doing well. And I think the states and the regulators have to be careful. And the reason why is there is a lot of great small businesses that advertise on these platforms. There's a lot of great exchange of commerce and ideas and thoughts and travel ideas. And this is vital to how we operate as consumers. How do I know what where the right place to travel is? I find it on these platforms. I see what my other friends are doing. I'm like, wow, that's exciting. I've said this repeatedly, like the majority of my clothes I buy are not in the store anymore. They're me flipping through Instagram and seeing a new lightweight pant that I didn't have, or a new shirt that I didn't have a color in. And I'm buying directly from those providers. So if they keep cracking down and we can't see that, and I think it ultimately impacts the broader economy, because this is an incredible opportunity for entrepreneurs to get their word out, this is the number one platform. We're not opening newspapers anymore to look at the classified ads of when a garage sale is coming. That's not how we're going to function going forward, right? We're functioning on these platforms, and if it's done correctly, and I'm not saying that the regulators are wrong, I think there's a middle ground, and you find the middle ground, then everyone moves forward together peacefully, and I think we can. And I think ultimately the power of the platforms win, because they're having a major impact on our lives in a good way. And so it's not all good. I'm just saying, like, for the most part, what I see, there's a lot of good, and the right time use and the right content geared correctly. So we want regulators involved. We want this to be policed. We want there to be a middle ground. But I don't think it's hey, they're getting involved, everything's shut down, and I don't perceive it to be that.
Yeah, certainly lots of questions about what exactly this could potentially look like. But Brent, when you take a look at the performance of a number of these names since the start of the year, they're not worried about any regulatory risk as of right now. I mean, these stocks have been off to the races. Even today, Amazon hitting the highest level they've seen since October 2022. Google, the highest level since April of 2022. Does that momentum that we've seen in tech enough to continue?
I think it is, because tech was such a tough year last year, and no one got it right. We certainly aren't going to sit here and say we got it all right. I think ultimately multiples and expectations of tech got carried away, and everyone thought it was going to be up and to the right. So what I would say is I think that we regained some speed. A lot of these multiples got hit. A lot of portfolio managers went into energy. They went into other areas. Now we're seeing the scattering, right? We're seeing money coming out of regional banks. We're seeing money come out of energy. We're seeing money move. So this is a fund flow issue. It's not like tech waved a magic wand, it's all better, right? I think this is a fund flow issue among institutional investors, number one. And then number two, I think a lot of the big tech companies have done the right thing. I mean, Meta last fall, from their spend plan to now, I mean, stock's up 100% because Zuckerberg put the air brakes on expenditures and had a proactive, employee reduction, which was the right thing to do. So I think that the tech trade has gone a long way. I think in any time when you've had this magnitude of move, you tactically have to tap the air brakes a bit. My sense is we're going to grind higher. We're not going to fly higher. We have flown higher across the board in mega cap tech. And so I think it's a grind higher from here. But I've said this repeatedly. I think that a lot of these companies are in a better position because of the actions they took on their headcount, their cost controls. They've become more disciplined in their messaging to investors. I think they're doing the right thing, and they took a good old-fashioned pullback and some wind in their face to make this happen. And we're now seeing most of these tech companies, really come back to earth, and that's a good thing. So I think it's a grind higher for mega cap tech. I don't think it's a fly higher from here because we've already had a fly higher.
Brent Thill, Jefferies senior analyst. Always good to talk to you. Appreciate you stopping by.
Thanks.
Well, coming up, we are breaking down the latest from the bank hearings with former chair of the FDIC, Sheila Bair, joining us after this short break.
Shares of Bath & Body Works among the big winners on Wall Street today. Yahoo Finance contributor Remy Blair is on the floor of the New York Stock Exchange with the details. Remy.
Well, in today's trading session, we saw the major U.S. equity averages trade on a mixed note. And as we head into the close, we are seeing continued mixed trading for the major equity averages. But as you mentioned, one stock that we've been watching here on the trading floor is Bath & Body Works. Shares of the company popped by as much as 10%, and this came on the heels of its fiscal first quarter results. This week, we've been getting earnings out from the big box retailers, and we've been getting insight into the American consumer. But Bath & Body Works has been bucking the trend when it comes to discretionary spending. The maker of scented body care products as well as home fragrance items reported a fiscal Q1 beat and also raised its guidance for the full year. While sales for the quarter were down from a year ago, they were higher by a whopping 50% compared to the first quarter of 2019 before the pandemic. Now, CEO Gina Boswell mentioned in an analyst call that its customers took to limited product drops at its stores, as well as new natural formulations for its body care products. In addition, its loyalty program has attracted 37 million members, and it currently offers perks as well as promos to its customers. The company also plans to launch grooming products for men, and it comes on the heels of high demand as well as success for its men's fragrance business. The company expects to expand into face as well as beard care ahead of Father's Day this year, and also plans to expand into men's hair and shaving products later in 2023. Later on this month, as well as next week, we will be getting other retail earnings out from Lowe's as well as Kohl's and Nordstrom, giving us a better idea of discretionary spending for consumers.
We'll be looking forward to that because we have certainly seen a pullback here in a number of the names that have reported this week. Remy, thanks so much.
Well, banks have been a focus on Capitol Hill this week thanks to a series of hearings focused on the failures of Silicon Valley Bank and Signature Bank. Regulators are on the hot seat today, but lawmakers on both sides of the aisle taking aim at the CEOs on Capitol Hill earlier this week.
Your lack of judgment, Mr. Becker, shows that you should not have been running the bank.
There are CEOs and banks all across this country that are having to pay up for your mistake.
And the taxpayers of America had to pick up the tab for your stupidity, didn't they?
It sounds a lot like the dog ate my homework.
Your opinion on what is a responsibly managed bank is now laughable.
This was bone deep, down to the marrow, stupid.
Joining us now is former FDIC Chair Sheila Bair. Sheila, we should note that was all directed at the SVB CEO, Greg Becker. A lot of finger pointing here, but he certainly didn't point the finger back at himself. There's questions about whether, in fact, the bank had too many uninsured accounts, whether social media had some kind of play, whether it was about digital banking. As you take a step back and look at what has played out so far, where do you think the regulation needs to focus on?
Well, interest rate risk management at the core, that's a pretty basic function for bank management, is to manage interest rate risk, which they just didn't do. And that became particularly devastating when they also had cultivated a very unstable deposit insurance base with such excessive reliance on uninsured deposits. They probably assumed, since these big depositors had other relationships with them, is all part of the same Silicon Valley venture capital club, they would remain loyal, which obviously they didn't do. So, but at the heart, it was interest rate risk management. They had a lot of unrealized losses on securities they were counting as liquid that were not liquid because if they had to sell them to meet the deposit withdrawal demands, which they had to do, they were going to have substantial losses, which was going to wipe out their capital. So it's not. That's what happened. I don't say I have sympathy. I do think that the larger environment of, the pandemic spending, all this deposit money coming in, massive amounts of treasury debt issuance, a lot of banks had increased amounts of uninsured deposits and bought a lot of government securities because somebody had to buy it, and there's a lot of it out there. But that's a broader challenge for the system, which they can manage. But this bank in particular really loaded up on long-dated stuff to get yield and really had an unstable deposit base, and it worked until it didn't.
Sheila, what about the role of social media here and what that played in the role of the deposit withdrawals? How should banks be assessing the risk that social media poses now?
Well, I don't know if there's much you can do about it other than cultivate a stable deposit base and have a clean bank. I mean, social media did create the problems. I would say with Silicon Valley now, though, those deposits were going to run as a group. It was all part of the same kind of closely affiliated community. They didn't need Twitter to communicate with each other that they were running that bank. So I think with regard to SVB, that is an overstated risk, but it certainly just underscores the importance of having stable liquidity. Long-term debt's another way you can supplement your deposit funding. That's really stable. People buy long-term debt, they're stuck there for a while. And then again, having a good, strong insured deposit base. And if you have uninsured deposits, people that have a true affiliation and loyalty to the bank. But most important, don't take stupid risk. Have a good, strong balance sheet, and you won't have a deposit run, regardless of what somebody might be saying on Twitter. I do think this short selling thing, I don't support a ban on short selling, but I do think there have been some I suspect there's been a lot of shorts out there spreading misinformation on social media that creates downward pressure on the stock, which also scares people. And I think the SEC should be all over that. I agree with the banking organizations that have called for the SEC to vigorously investigate some recent incidents and hope they will do so.
Let me follow up on Shauna's point, though, because it's not just about SVB where we've heard this argument. That is to say that, look, anybody can raise the alarm on Twitter, any kind of social media platform, and then the ease and speed with which you can withdraw your deposits through digital banking only accelerates the problem, regardless of what that liquidity picture looks like. So, number one, is that a fair argument? And is there anything that can be done on that front?
Well, look, it's not completely new. I mean, during the great financial crisis, when I chaired the FDIC, we were constantly fighting rumors on the internet. Social media was not so much a force, but stuff went viral on the internet very, very quickly about the FDIC. The FDIC was running out of money. Boy, did I have to keep betting that down. So this is not a new problem. It's just different venues can spread this misinformation very quickly. I'm not sure there is much you can do about it, except, when people are manipulating markets through misinformation. The SEC has some authority there to crack down. They should crack down. But most importantly, it just underscores the importance of having a well-managed, well-run, strong balance sheet for your bank. The truth will eventually prevail, as it is, I think, now. There was all this scare about regional banks, writ large. And now I think through some good communication from the government, analysts, people like me know the vast majority of these banks are just fine. The truth is prevailing. Things are calming down. But, the ones that are vulnerable, and there's still a few out there that are vulnerable, they're going to have to keep batting this stuff down. And again, it just emphasizes that even more important now to have stable deposits and a strong capital base and good assets on your balance sheet.
Sheila, when it comes to the stress that we've seen in regional banks, the Fed's role in this, is the Fed making it worse by continuing to raise rates? And what happens if we see another rate hike in June?
Yeah. Well, actually on Yahoo, I called for a pause on December. And I'm an inflation hawk. I really don't like inflation. I really don't like low interest rates. I've been worried about it for years, creating the kind of instability, leverage, inflated asset values that we're having to unwind now. So, yeah, I think it looks like they're going to probably be hitting pause next time. Pause is not a stopping it. Pause is not reducing rates. Pause is just a pause. Assess what the impact of these really rapid, dramatic rate increases have been over the past year. So I hope those are the signals, and I hope that's what they do. I think it's better to tolerate a little more inflation a little longer than precipitate a financial crisis, at which point we're going to have a very severe recession, and they're going to have to take rates back to zero again. And you know what? We're going to be right in the soup. So that is the worst case scenario they should avoid at all costs. Slow down, stop at this point, pause, not stop, pause, assess, and let the markets and the economy adjust to these dramatic rate increases that they've undertaken.
And Sheila, the other big issue that the market's watching closely is the negotiations down in D.C. over the debt ceiling. What risk does this potentially pose to the economy, to the markets? And are you confident that we'll get a deal before that X date?
Yeah. Well, yeah, I am confident. I've seen these kinds of games, and I've said in other contexts, it's a global embarrassment. Why we put ourselves through this, I do not know. At the 11th hour, they will have an agreement. I think people broadly understand on both sides of the aisle, the U.S. government cannot default on its financial obligations, and nor can you pick and choose what you're going to pay these people, but not these people. That's just not what a developed world economy, a sophisticated economy, a sophisticated democratic institutionally managed government should be doing. So I think they will get an 11th hour agreement, but the drama around this is scaring people. I get emails and calls, are my T-bills, I'm going to redeem my T-bills, what am I going to do? It's scaring people. Are my mortgage rate's going to go up? It's scaring people. It's unnecessary. And, both sides are right. We shouldn't be defaulting our debt or even talking about it. On the other hand, we are on a fiscally unsustainable path. We have to get spending under control. We should be looking at tax revenues, too. So both sides are right, and it's frustrating. But, I have very high level of confidence. They'll get an 11th hour deal. I mean, there have been some positive signals already from both the president and the speaker. So fingers crossed it gets done soon.
Coming down to the wire, right? Sheila Bair, former chair of the FDIC. Thanks so much.
Thanks for having me.
Well, coming up, we dive into some of the top trending stories and tickers on the other side. Stick around. As we count down the final 15 minutes of trading, let's take a look at some of the top trending stories of the day. First off, Disney's ESPN, the Wall Street Journal, the first to report that ESPN is looking to launch a standalone streaming option of its flagship channel. Now, there's been speculation about this move for quite some time. The big takeaway, though, is it's going to potentially reshape how Americans watch live sports. And Yukiko, it could also have major impact here on cable TV providers. We know so many people who haven't cut the cord yet haven't done so because they love watching live sports. Yes, there's other options in terms of what streamers some of the competitors out there offer, but this could certainly be a massive hit here to those cable providers.
Yeah, I mean, you get the sense that this ESPN spinoff is basically inevitable. It really is about the timeline, but I have to wonder how much competition is already out there. I mean, you bring up a good point about what this means for the cable providers, but what does it mean for ESPN in what is an increasingly crowded landscape? You look at the likes of Amazon, you look at Apple, they're already gotten in on live sports. You have Google now doing NFL Sunday Ticket. And so ESPN's not the only game in town anymore when it comes to sports offerings and streaming. You know, I wonder about the timing of all of this and to what extent ESPN competes.
That's true, Akiko, but I will say that it's such a big brand, right? People know ESPN. According to this journal report, it would still be offered on cable, but will also be available fully over the top. And this is nothing new. We heard Bob Iger say repeatedly over and over again that eventually ESPN will be a full OTT and that sports continues to be a really solid part of Disney's overall strategy. The timeline is a little murky. I could see it maybe 2024, 2025. I don't think we're going to see that change happen this year. But Shauna, to your point, I do agree that a lot of people subscribe to cable solely for sports. If you have a huge brand like ESPN available elsewhere, what does that mean for the cable?
And we do. We're a household we're in that group. We subscribe to cable because my husband argues he needs it for sports. So maybe I need ESPN to offer this so it could strengthen my argument that we'll be one of those cord cutters too.
I just want to say one thing. I think there's a lot of risk here because I think the article put out $9.42 is the average amount that each cable bill pays to ESPN. So they're going to be losing out on that and sort of trying to cover it with this over-the-top offering. That's a big risk. That's a lot of money in the bank every month that, of course, they've been losing recently because of the fact they've been losing the cord cutters. But I think you're going to alienate some of these big major cable operators earlier rather than later at this point.
Okay, let's talk about what I'm watching here. A new poll out paints a pretty grim outlook on artificial intelligence. According to a Reuters Ipsos poll, more than 2/3 of Americans worry about the negative effects of AI, with more than 60% saying the technology could threaten civilization. The poll went as far as to break down the concerns by an individual's political biases. 70% of Trump voters, for example, expressed high levels of concern compared to 60% of Biden voters. And then among religious Americans, evangelicals expressed the most concern. Now, I'm going to take a step back here and say that I think the doom and gloom of AI has been a little overstated. Number one, we should say a lot of this was elevated because of the developments over ChatGPT last fall. AI's been around. We just haven't necessarily seen it in this application. And so I don't know about the wording of this poll, how people were asked, but you know, the negative headlines have been there, and yes, there are concerns, but there's also benefits in medical research, you know, in for example, cancer research. We've heard so many different applications that are also positive. You know, the question is that getting elevated too? Not to say there's not negative things with AI, but I do think that has really outweighed the positive, at least in the headlines that we've seen.
I think it's that ChatGPT effect has sort of scared people in some sense, like how powerful this tool is. I can't tell the difference between this and a human being and a computer at this point, right? So I think that's the scary part. On the flip side, you know, there's a lot of, like you said, benefits to this. Most recently, I'm kind of reminded what Elon Musk said a couple of days ago, talking about how he was scared of AI, we need to regulate it. But then at the same time, FSD, the full self-driving, is powered by machine vision and AI, and he says that's the next greatest thing. So he's kind of talking out of both sides of his mouth there. So there's that huge benefit, the debate of the benefits and the sort of cons of AI. I think right now, Kiko, you're absolutely right. Let's focus a bit more on some of these positives. Right now, there's a lot of doomsayers out there saying, you know, are the robots going to come after and get me? I think I'm more concerned about my job at this point than not necessarily, you know, the robots.
Yeah, the job impact. I mean, that's one thing that certainly is being debated out there. We know Goldman was out with a recent estimate saying that it could potentially impact 300 million jobs. That's not, though, necessarily a bad thing. Yes, it's going to change how people do their jobs. It's going to enable some workers to be more productive. Yes, it's going to eliminate some jobs out there, but people, of course, will then reposition maybe their careers in order to reshape it. We've seen this happen before when it comes to the internet, other things, obviously, that have been developed in the past. So it's clearly going to have an impact on jobs, but I also don't necessarily view that as a big threat or a negative.
And I'm not surprised by the results of this poll, to your point, Kiko, because of the negative headlines, because of everything we've been hearing. I've seen iRobot. If you're an average American, you're freaking out a little bit right now. So I understand the results of this poll, but I agree with you guys. We have been using AI in everyday life. So, and I just want to point out, even though AI is a concern, crime and economy ranked higher on the list of issues, with 77% support increasing police funding to fight crime, and 82% are worried about the risk of a recession. So it's not just all about AI. Moving right along, though, to my story that I'm watching today, Netflix revealing at its upfront presentation on Wednesday that its ad-supported tier has 5 million monthly active users, otherwise known as MUAs. Now, it's important to note here, guys, that Netflix didn't reveal the exact number of ad tier subscribers, and monthly active users can also include multiple people using the same account. So an important caveat there. The company did reveal, though, that the ad member base has more than doubled since the start of this year, with more than 25% of Netflix signups now choosing the ad-based plans when it's available. Netflix has reiterated that the ad tier will generate about $3 billion in revenue. That represents about 10% of overall revenue over the long term, although analysts seem to think that won't happen until at least 2025. But investors, they don't seem to mind being a little patient here, because shares are surging today, the best intraday performance since October of 2022.
I'm a little surprised that there's 5 million people willing to suffer through ads for to watch Beef and shows like that. I just can't do it. But look, I guess we were wrong. I mean, I guess I was wrong in the sense that Netflix actually is able to monetize these users that don't want to pay anything, and they're willing to sit through the ads. Advertisers will pay for that ad inventory, and Netflix is benefiting. So they're kind of collecting the entire pie of people that are sort of streaming content now, and not just TV people either.
Yeah, certainly.
Yeah,
and I think Hastings has said that they were obviously late to this game when it comes to their ad-supported tier. They're offering there. Sarandos has said in the past that that's likely the company is going to offer multiple subscription plans with ads in the future. I'm with you, though, Pras. I haven't made the transition just yet. It's cheaper, though, so it's attractive to me.
I'm with you guys. I tried the ad-supported tier with Hulu. I couldn't sit through the ads.
Oh, I do it for Hulu.
I do it for Hulu, too.
And I don't know why.
I don't know why either.
It doesn't make any sense.
All right, guys, a little wealth watch here, turning to watching it. Another thing. Watches of Switzerland, one of the largest Rolex dealers in the world, warned sales might slip in the next quarter or two, and it's not necessarily because of demand, but supply. Waiting lists are strong, but the retailer just can't get enough supply to sell, which might weigh on revenue. On the flip side, the secondary or used market, at least the top end, still going strong here. Over the weekend, auction houses, Phillips, Sotheby's, and Christie's, they each had their own watch auction there. So they combined $108 million worth of watches, with a bunch of new world records being set for certain models like Daytonas and other AP watches. So really a big deal here in the watch world. People had thought that there was some slowdown after the crypto kind of collapse, and people kind of getting scared with higher rates and of course, macro concerns. But the watch world, maybe I need to be buying watches and diversifying into more luxury watches.
You're making more money than me then, Pras, if you're looking at luxury watches.
Yeah, right.
I was just going to say that. I would love to buy one of these way beyond my price point, 100 times full probably what I'm willing to pay for a watch. But it's interesting when we see the demand maybe pull back just a bit. We're really just normalizing from that pandemic craze that we had seen for about a year and a half, 2 years. The prices, though, people are still willing to pay in this environment when so many are pulling back on discretionary, really just points to the fact that the luxury consumer is in a very good position right now.
Yeah, and Rolex also, they're rolling out not only expanding production with 3 new factories, but also launching their own certified pre-owned program to get make these used watches a bit more palatable, give them a bit more value. And maybe that's where the deals are, Shauna and you guys, for yourself or maybe your significant other, some gifts maybe, I don't know.
Yeah, I like that.
I don't know, I think that might be out of my price range.
I was going to say, we need significant discounts, so we'll see how much of that actually come down. All right, guys, thanks so much. Coming up next, we are counting down to the closing bell here on Thursday. Stick around for more market coverage on the other side.
Well, travel is coming back with a vengeance post-pandemic, especially for international trips. The U.S. State Department says they are getting 500,000 applications a week. That is up by at least 30% for 2022, which saw a record high. Joining us now with her perspective on the travel outlook is Haley Berg, Hopper, lead economist. Haley, this is really fascinating to see because these international tickets are not cheap. And yet it appears as though travelers out there are saying, it doesn't matter what the price tag is, I'm going to take my trip this year.
That's exactly what we're seeing. Airfares to Europe and Asia, the top two regions for summer travel, up 37% and 60% versus 2019, respectively. These tickets are not cheap, $1,300 to $1,800 per ticket, but it's not slowing down travelers. We're expecting this to be the biggest international travel summer since 2019, and travelers are continuing to pay the price.
Haley, what about domestic trips? Is that the case for that, or have we seen a bit of a pullback there?
Great pullback on airfares domestically, averaging about $300, down from over $400 at times last year. So a lot of relief for those travelers who are staying domestic on both fares and rental cars for those road trips.
Yeah, so if we're talking about high fares, I mean, how much more are we talking about in terms of that price tag? And how much of that is driven largely by fuel costs and other issues?
For travel to Europe, about $320 more per ticket than this time in 2019, about $350 for travel to Asia. Part of it is high demand. There are more people looking to go internationally. It's the first summer with no travel restrictions to most countries. Jet fuel prices, though they've improved since last summer, remain high. Those long-haul flights, they're more expensive to operate. They guzzle more fuel. That combined with low supply, Asia is still under 60% of the capacity headed from the US to Asia we had in 2019. Europe is better, about 80 to 90% capacity, over 100% on some routes, but in aggregate, we're still far behind where we would need to be. All of that's pushing up fares.
Haley, what do you think is driving the interest that we're seeing in Asia? Because taking a look at your trending destinations list, Asia makes up the top 3 cities there.
Yes, we're seeing huge demand, especially Tokyo, Ho Chi Minh City, a lot of these destinations that have been inaccessible for 3+ years. So it's a combination of travelers going home to see family or friends for the first time, vacations, bucket list trips that have been pushed off. And then Asia pre-pandemic was a growing, fast-growing tourist destination with a lot of unique cities. Some of these countries are low cost once you get there, high airfare, but low cost to spend a week or two there. So we expect to see it continue.
Yeah, Haley, I will tell you, I just came back from a trip to Japan, and that price tag, when I looked at the airfare, was a bit of a sticker shock. Tell me about some of the other searches that you're seeing in terms of where people are looking to travel, especially internationally. And then secondly here, how much are they willing to shell out?
We're seeing that the typical European destinations remain highest demand. So think London, Rome, Paris. In Asia, big cities like Tokyo, Osaka is a trending destination within Japan as well, and Singapore. But off the beaten track, we're also seeing destinations in Africa. Morocco is one that we've seen a tremendous amount of growth to, as well as Buenos Aires in Argentina, which, though it may be about $800 to $900 to get there, your budget spreads a lot further given the dollar trades much higher value than the Argentine peso.
And Haley, real quick ahead of the closing bell here, the best time to book travel, when is that?
If you are traveling for summer, it's right now. You should have booked international trips by now, so book now. If you're traveling late August for domestic trips, you have a little bit more time. Typical rule of thumb is book 1 to 2 months in advance of departure dates for domestic.
All right, so you still got a little bit of time if you're looking to travel this summer. All right, Haley Berg, Hopper, lead economist, thanks so much. Let's do a quick check of the markets here. All 3 of the major averages trading to the upside. You have the S&P closing up just about 1%. The Nasdaq, the leader of the day with a number of the tech giants trading to the upside, hitting the highest levels that we have seen in over a year. You're looking at the Dow closing up just about 115 points. Let's take a look at some of the biggest movers of the day. First up, we got to talk about Walmart. Shares closing the day in the green, up just about just 1% off the highs of the day after Q1 earnings came in stronger than expected. The retailer beating on both the top and bottom lines, lifting its full year guidance. And Kiko, a number of data points that were very positive here for the company. Online sales, one thing that stuck out, inventory levels, some progress there. And also the fact that they are expanding their customer base. More high-end shoppers are now shopping at Walmart, and Walmart is working to keep that extra customer base.
Yeah, a lot of those trade downs working to the benefit of Walmart as they bring in new consumers. And also worth noting that the new mix that we keep hearing from retailers, this more focus on groceries and everyday items, that plays to the strength of Walmart. And we've seen that reflected in the earnings out today. Well, Netflix is closing the day up today as well. Its ad-supported tier is beginning to grow. The streamer revealing today that its ad-based plan, dubbed Basic with Ads, has 5 million global monthly active users, and you see the stock getting a big lift on the back of those numbers, up about 9%. We were, kind of asking questions yesterday, Shauna, going into the upfronts for Netflix about just how significant that ad pull was going to be for them. This is the first time they've given us a number here. Investors are certainly liking that in a big way, even in this environment where we have seen a big pullback in ad dollars.
Yeah, certainly. We're looking at the biggest gain for the stock since October. Netflix clearly did impress with the numbers that they put up, with the plans that they do have for their ad tier, and something that investors have been waiting for. Investors have been betting on the success of this, and they really came through and proved that with their upfront presentation. The excitement about that. JP Morgan reiterating their overweight rating. Another nugget to point on here, more than a quarter of the new signups chose the ad plan in regions where that was available. So certainly a welcome sign there for Netflix that has been struggling to grow their subscriber base. All right, another sector that we are watching is housing. New data on mortgage rates and existing home sales coming in today, showing us the health of the housing market. Yahoo Finance reporter Danny Romero is here with more insight. Danny.
Here in this small San Bernardino County, here in California, there are 3 homes up for sale, less than a mile apart. This home behind me is listed for $750,000 and has been on the Redfin's website for over a month now. Now, that is just one example of what is really going on in the housing market right now. More homes are sitting on the market a little bit longer than usual. And sales of previously owned homes have fallen, not only on the West Coast, but also across the country. And that is due to that limited inventory and those higher mortgage rates. We saw mortgage rates edge up this week, still sitting above 6%. And here on the West Coast, home prices are fluctuating, and that is seasonality. Prices are usually higher in the summer and spring months compared to the winter time. But one of the factors that is still weighing on the market is the number of homes that are listed for sale. So fresh data from the National Association of Realtors shows that an increase in inventory really did happen this month in April compared to last year's numbers, but that's really smaller than the usual numbers. And that is because homes are sitting on the market a little bit longer, Shauna.
So, Danny, if you're talking about sort of the previously owned homes getting hindered in some way, what is the new home market looking like right now?
Yeah, the new home market is a really bullish market. We've seen a lot of home builders' confidence really tick higher, and that is, more than a third of homes is due to those newly construction homes. And so that's really increased the incentives for home builders to build more homes. We even saw in recent data that both building permits and also housing starts for single family homes ticked back up. They've increased month over month. So really a strong optimism in that new home market, Akiko.
All right, Danny Romero, thanks so much.
Well, Disney is ramping up its battle against Florida Governor Ron DeSantis, now canceling plans for a new campus outside of Orlando. Ali Canals here with the details on this, along with Rick Newman joining in on the conversation, talking about the political implications. Ali.
Hi, Kiko. Now, Disney didn't specifically say this was because of the governor, but you can probably surmise that the DeSantis drama played a significant role. According to an internal memo obtained by Yahoo Finance, Josh D'Amaro, who chairs the Parks, Products, and Experience division at Disney, told employees today that the company, which had been building that new campus in the Lake Nona region of Orlando, was now scrapping those plans. So no more construction on that campus and no more relocation requirements since about 2,000 California-based employees were going to have to relocate to Florida. Tomorrow saying, quote, given the considerable changes that have occurred since the announcement of this project, including new leadership and changing business conditions, we have decided not to move forward. Now, the relocation plans were first announced in July 2021 under then CEO Bob Chapek, with the employee campus originally set to open between 2022 and 2023. That was eventually delayed to 2026. And now, of course, that is no longer. Tomorrow saying that Disney still has plans to invest $17 billion and create 13,000 jobs over the next 10 years in Orlando. He said Disney still has plans to do that. But remember, just last week during the earnings call, Bob Iger got very frustrated with the DeSantis drama and basically said, does Governor DeSantis not want us to invest in the state of Florida? So this is just another development in that ongoing saga.
Certainly is. Rick, what are the political implications here? Obviously, not good news, you wouldn't think, here for Governor DeSantis.
And it comes as he's apparently preparing to say formally that he's going to run for president next week. Bob Iger, the Disney CEO, has said that DeSantis and his policies are anti-business, and now they're showing it. And I think, if you look at the backdrop here, DeSantis is used to pushing people around in Florida and not getting a lot of pushback because he won re-election by a large margin, and he has a lot of sway over the legislature. So people don't really want to cross him, but he finally met somebody who's willing to push back. And it's really making him look small. Disney seems to have a solid legal case with regard to that municipal district DeSantis tried to take over to punish Disney. And let's just remind everybody, this dispute actually has nothing to do with business. It goes back to last year when Disney took a stance against the law that dictates what you're allowed to teach young kids about sex and gender. Disney opposed that because a lot of its employees wanted them to do that. And now DeSantis has sought retribution against them. So this is just not going to play well. DeSantis is not actually doing anything that's for the business. He's just taking after businesses for political purposes, and he's going to have to explain this to a much broader audience.
Yeah, and that's my follow-up there, Rick. I mean, it does feel like things have gotten a little personal between the governor and Disney. And if it really is about sort of trying to win those political points, how is this playing within or among potential voters within the party?
We don't know. I mean, so we know there are polls. The polls show that Donald Trump is actually leading DeSantis by a pretty large margin among Republicans, but I think that Trump is obviously famous and well known. DeSantis less well known, but DeSantis has actually been drooping a little bit in those polls when he should be rising as his donors come together and he develops some momentum. DeSantis does seem to be vindictive, and he's going to have to either say, yes, that's what I behave that way because that's what I think Republican voters want me to do on these social issues and cultural issues where he's waging his culture war, or does he have to moderate that point of view somewhat? But he's kind of stuck here because he can't really make nice with Disney, I don't think, without losing face. And this is now in the courts, and this is going to go on probably well past the 2024 election. So this is going to be dogging him for months.
Ali, what about the investor impact or lack thereof that we have seen? Because we have talked about this time and time again, this ongoing feud. Now they're scrapping $1 billion plan here in Florida, yet we didn't really see it have a big impact on the stock.
It doesn't. If you take a look at shares, they closed slightly higher. They're trading flat in after hours trading. And you and I have discussed this, that investors don't really seem to care. They're shaking off this controversy. When Disney did report earnings, the stock actually tumbled as much as 9%. It was the biggest intraday decline in 6 months the following day after Disney reported a drop in Disney Plus subscribers for their quarter. So that seems to be what investors care about, the subscriber count and and the profitability, not necessarily this ongoing fight with DeSantis. Now, if this were to incrementally impact revenue or have some sort of direct impact to the parks business, I think that's when you could see investors care a little bit more. But for now, although there seems to be a lot of public interest in the story, from a shareholder perspective, it isn't impacting the stock.
A heck of a lot of public interest in this story. Right, Allie and Rick, great stuff. Thanks so much.
Bye, guys.
Well, coming up, we are talking all things travel ahead of the very important summer travel season. The CEO of Expedia, Peter Kern, will join us right after the break.
Welcome back to Yahoo Finance Live. I'm Brian Sazi, and it's almost time to pull out the old swim trunks and suntan lotion, hit the road for summer vacation. The summer travel season will come against the backdrop of a slowing U.S. economy and nagging inflation. Concerns about the debt ceiling aren't helping sentiment around travel either. Let's check in with Expedia Group CEO Peter Kern. Peter, always great to get some time with you here. We're getting ready for the heart of the summer travel season. From your perspective, what are you seeing in terms of demand?
Well, I think it's already summer, so you should get your swim trunks out and get going. But we're seeing a ton of demand. Obviously, a big pickup. You've probably heard in international travel this summer as international trends have come back. So lots of demand domestically, lots of demand internationally. Still not all of the airlift back across the world, so still some tightness in supply and air. And, unfortunately, that means prices are going to stay high for the summer.
Peter, how do trends in the business compare today or compare them to pre-pandemic levels?
Yeah, a lot of trends have actually returned to kind of pre-pandemic levels. When you look at the splits between domestic and international, when you look at the splits between big city versus beaches and mountains, which were, popular during COVID as getaway places. And we also saw a big stretch of duration of stay, length of stay during COVID, where people were basically fully hybrid or, weren't going in the office, so you could go work for a month from wherever if you could afford to. And so those trends have all basically returned to pre-pandemic, which is length of stay has shrunk, Big cities are back in a big way, and everything's kind of normalized, international to domestic. There are still a few spots. China's not fully back, parts of Asia, but generally things are returning to pretty much pre-pandemic normals.
Why are the prices climbing?
Why are the prices high? Is that what you said?
Yeah.
Well, it's a supply. Well, first of all, we had several years of inflation. We had more demand than supply. There's still demand outstripping supply. When you think of, we think there's been a structural change and more people just want to travel generally. It's not revenge travel anymore. It's just more travel as opposed to spending money on other things. And you've still, as I mentioned, got pockets where supply is not back fully. So prices were driven higher when there was tons of revenge travel, tons of inflation, and they got to a point, and now they're basically holding because demand has stayed up. And if you think about air travel, there's a little less supply in the world, so they can keep prices high. And in the hotel world, hotels have generally been willing to trade off a little volume for price because getting employees is harder. There's other issues. So we've seen, hotels, airlines, et cetera, sustain price. Car rentals a little different. Car supply has come back, and those prices have come down considerably. But certainly in hotel and in air, they're staying pretty high.
How long could this recovery in leisure travel continue? And I ask you that, Peter, because today we get an earnings report from a Walmart, yesterday Target, and they're telling us that consumers are very cautious, so cautious that they're maybe not putting an extra pair of socks or another pair of bathing suits into their shopping basket because inflation is so high.
Yeah, look, I think so far, again, we're not seeing any signs of it. I think it's clear that people are prioritizing travel over many other things. I don't know about socks, but, I think we're going to, it appears like it will sustain itself. And I think people, again, have slightly more time, not as much time as during COVID, but with hybrid work, there's a little more time for leisure travel. There's a lot of, factors going into it, but I think so far, and this is really across the globe, we're not seeing any real downturns from anything that we would all call, economic pressure. So will it sustain itself forever? Who knows? But depending on the depth of any, economic pressure we get, et cetera, it appears like travel will remain the top of the list of what people want to spend on. And that means, we should see travel and leisure travel hold up. Corporate travel is slightly different, but certainly in the leisure space, it's been incredibly strong.
Last time we talked, Peter, it sounded like you were getting ready to launch a new awards program. And I know a lot of the analysts in the street are excited to think about what that might mean to your bottom line. Where are you in that?
Yeah, so I'm even more excited than the analysts. So we are launching in July in the U.S. It's called One Key. It will encompass our big three brands, Expedia, Hotels.com, and Vrbo, and you'll be able to earn cash, burn cash. We're calling it One Key Cash across all of the products. So you can take a cruise and earn points and use it for vacation rental, vice versa, hotel, air, et cetera. So we're really excited about it. It's the first of its kind. We obviously have a huge member base, and we think putting the member bases together and, in vacation rentals, there hasn't even been a way to get rewarded. So now this will be the first real rewards program for vacation rental, which we think is really powerful for Vrbo. And even more importantly, the fact that you'll be able to share across all the brands. And we'll take that whole consumer base and be able to give them more benefits, more member discounts. We're sourcing more high-level discounts for people. There's going to be more package discounts. So there's a lot of benefits coming, and we're really excited. So we're launching that July 6th. Going to have a big party in New York. You should come, and it's going to be great.
Well, you know my email, Peter. By all means, send the invite. And maybe when I do come to that party, we could talk about your AI initiatives. You, along with a lot of other companies, are teaming up with or looking into ChatGPT. What are you doing there, and how will AI change the travel experience?
Yeah, well, first of all, we got to work on your party game, because if you want to talk about AI at a party, we have an issue. But putting that aside, we're really excited about AI. We've been working in the space for a long time. And as I said on our earnings call and many other calls, we've been working in the space to enhance the consumer proposition for years. And that goes into every big and little thing you see, whether it's what images we show you, how we sort and filter for you, and a bunch of other things. But the onset of large language models and ChatGPT in particular was exciting to us. As I say, we stayed in the front foot on AI for a long time. And when that came, we really got after it to see how we could use it to enhance the consumer experience. So the first place we've experimented with is we have a plugin into ChatGPT, and people can be in ChatGPT, ask travel questions, get recommendations from ChatGPT, and then click off into our environment. Now that's only for the developer universe and the paid universe, so it's not available to everybody yet, but we were basically the first in travel to get there. And then the inverse is maybe more exciting. We brought ChatGPT into our app, our iOS app, and we're basically allowing people to use ChatGPT to ask, where should I stay near the Empire State Building or near the Eiffel Tower? What are the best hotels near? Whatever. They can ask a bunch of questions. And then as they get recommendations, we save those recommendations to our trip planning products, and you can go in and search and compare and do all those things. But there's lots more potential for that, and we are looking at interesting ways to use ChatGPT to help in service, perhaps help people in search and sort if they want to ask longer, bigger questions. So there's really a lot of areas where it has application, and we're working closely with ChatGPT and looking at ways where we can utilize the technology.
As a leader working so closely with AI, Peter, I know there's some very interesting initiatives. Bigger picture, do you have any concerns how AI impacts the economy over time?
Yeah, we've watched a lot. I've watched a lot of the debates. I think they're really interesting, and obviously there are implications for humanity. And I know people like to get focused on the political environment and other places where it can be used or perhaps abused. I think many have said, including Sam Altman, that probably regulation will be required, and I think that's a healthy thing. But I think when people think about it, they get over biased towards all of those dramatic stories. There are a lot of really, really good applications that don't take jobs away, don't change the political climate, that really just enhance people's experiences with products that we use every day or try to use every day. And I think if you think about all the ways that can enhance people's experience, if searching's complicated, there's all kinds of applications of people with that are have disabilities or other challenges. So there's a lot of great uses and utility to really enhance what people are doing as opposed to replace what people are doing. So I think in our environment, it's a perfect example. We had to build guardrails for ChatGPT so that it would only answer travel questions. We didn't want it to get into other things with our consumers. We're not interested in answering those problems. So you have to, you can't just set it free and see what happens. You have to use it for a particular application. But if used in the right ways, we think it's incredibly valuable to enhancing a consumer experience, our workers' experience, our service personnel will be able to use it someday. And we're constantly working to enhance those things. So if this helps us do better, that'll be great.
Well, when I see you at that party in New York City, Peter, we have bathing suits and artificial intelligence to talk about. Expedia Group CEO Peter Kern, always good to see you. We'll talk to you soon.
Thanks, Brian. Look forward to your bathing suit recommendations. Thanks.
I'm just going to show up wearing it. Peter Kern, thanks so much.
Take care.
All right. And well, we're off to break. See you later.
we are seeing the markets close in the green today with the S&P 500 notching its highest close since August. A lot of uncertainty, though, still in the markets, especially with concerns around the debt ceiling debate as well as the Fed. So we're going to take a look at a couple of stocks to consider and a couple you may want to avoid with Tim Pagliara. He's Cap Wealth Chief Investment Officer. Tim, let's start with the two picks that you really like. Chevron is one that I want to hone in on because energy was the best performing sector last year. It's the worst performing this year. What do you see there that you like?
Well, I see an improving global economy. I see increased demand for oil at a time when supplies are a little tightened. It's a great company with great operating earnings. It's a dividend play, 3.85% dividend. And it fits the profile of a conservative investor that is looking for consistency and a long-term runway of success.
Hathaway, Warren Buffett has liked in the past here. Tim, Berkshire Hathaway is one of your picks. Why are you so bullish on Berkshire Hathaway? And what do you think the future looks like for that company, potentially without Warren Buffett at the helm?
Well, first of all, I think he's done a great job of putting a tremendous team around him, led by Greg Abel and they have tremendous discipline. When treasuries were 5 basis points, they were there buying them every Monday morning, $125 billion worth of treasuries. And now that $50 million worth of operating earnings from his cash turns into $5 to $7 billion. So he's got a lot of wind at his back. They have the opportunity to take advantage of any of the dislocations that are going to continue as the Fed tightens and tries to bring, inflation under control. So it's kind of a golden period for a company like Berkshire Hathaway that really has been out of favor just because of their discipline. So I'm excited about it, and I think they will have a really good 3 to 5 year plus run.
Let's take a look at two stocks that you're bearish on. These are two high growth names that some would argue just grew at a rapid clip during the pandemic and have now seen significant pullback. I'm curious to get your take on Zoom, though, because you could argue it's a little different from Peloton in that the use cases are still there. Is this a valuation play? What are your concerns with the stock?
Well, they really haven't found a way to monetize their business model, and their business model doesn't have much of a moat around it. And people are going back to work. They're going to be back in the office. So a lot of the dynamics that made it successful during the pandemic are starting to wane. At the same time, they're not generating excess capital, and those are the kinds of companies that you want to avoid during a period like this. Price of credit is really gone up. I mean, there's no really even 8% money out there, except for the best credit qualities of customers of banks. And, a lot of people are paying 12 to 15%, which just sounded outrageous 3 years ago. But it's a reality again.
Tim, what do you think the future then looks like for the company? Could they be a potential M&A target?
We've excluded it from our list of companies that we follow for the reasons that I told you. So I don't know that it makes a good merger candidate or possibly an acquisition candidate at some point where it's a bolt-on. I believe the period we're in right now mimics a lot of what we saw with the dot-com bubble of 2000. Take a company like Sun Microsystems. From 2000 to 2010, it lost 98% of its value, and Larry Ellison bought it up for $7 billion just so he could buy an operating system and stick it to his old friend Scott McNealy. So, there are a lot of these companies that just will not survive as standalones, and they may get bought up by another company, but it's not going to be, a core business like everybody had envisioned during the pandemic.
You talk about potential acquisition targets. Peloton, one that's getting named a lot, and you mentioned that as your one stock that you're very bearish on. You've raised questions about the sustainability of its business model. I wonder if there's a counter argument here, though, that the stock has fallen so much. This is a company that is very much in a restructuring mode. Does it make sense for investors to potentially position themselves for the turnaround?
In our opinion, Peloton was the poster child for the excesses of the market. You know, $186 a share to where it is today, sub $10. And it just never had the characteristics of a really good business at the valuations that it had. So what somebody would pay for it, why they would buy it, you know, they have a subscription model. I think you're going to even see weaknesses in that as people go back to the gym and you know, so it's just a difficult call, and it represents to me a lot of what was wrong in that free money period that the Fed still has challenges to correct.
Cap Wealth's Tim Pagliara with his top picks. Great to have you on today. Appreciate the time. Well, coming up, commercial real estate prices have fallen for the first time since 2011. We're going to talk to the CEO of Marcus & Millichap to break it down on the other side. We'll be right back.
Commercial real estate prices fell in the first quarter. That's according to Moody's Analytics. It's the first time since 2011 that CRE prices have declined. Joining us now for what lies ahead for commercial real estate, we want to bring in Hassam Naji, CEO of Marcus & Millichap, an investment brokerage company that specializes in commercial real estate. Hassam, it's great to see you again. So Moody's out say that they saw prices decline in the first quarter. Is that consistent with what you're seeing within your portfolio?
Good afternoon. Great to be with you on the program. Yes, it is. We are intermediaries and advisors to buyers and sellers. We don't actually own the properties ourselves, but because of our real-time sense of what's happening with seller expectations and buyer expectations as the largest investment brokerage sales force in the country, really North America, including Canada, we have a real sense of the gap between that kind of bid-ask spread. And it's as wide as it's been really since the great financial crisis because of the interest rate shock. The interest rate shock has been profound. 500 basis points in a year is enough to cause a disruption in valuing real estate and really creating a lot of uncertainty and confusion. So I'm not surprised to see Moody's index show a price decline. If you look at publicly traded REITs, they're down about 20% year over year. Public markets always react, maybe overreact on the way down and on the way up. The private market isn't quite as quick to respond. And so price corrections are somewhere between 10 to 15% based on what we've seen so far. But you have to remember, a lot of sellers are not bringing properties to market because the healthy fundamentals of properties, good occupancies, good rents, cause no real urgency to bring product to market when there is a disruption like this. On the flip side, we have some maturing loans and some distress that are bringing some inventory to the market as well.
You know, Hassan, we've been watching those office occupancy rates really closely because some companies have just struggled to get workers back to the office. It's been particularly glaring when you look at vacancy rates in places like San Francisco as well as New York. What are you hearing from sellers on that front, and how do you see those spaces evolving? Because some companies just aren't going to bring their employees back.
It is a major structural challenge for our office clients across the country. What's amazing is that some metros, like you mentioned, New York, San Francisco, downtown Seattle, have seen urban vacancies go up significantly, while others, for example, Las Vegas or West Palm Beach or Miami, have seen vacancies stable or even come down because of in-migration of both companies and workers. So it's not a general trend that is behaving the same across the country. Suburban markets tend to be doing much better than urban markets. And the pandemic really delivered a structural change to the way that the workers want to come back to the office or not. We're seeing a lot of incentives and a lot of initiatives by companies to bring employees back, but nonetheless, occupancies on a daily average are barely above 50% across the country. Again, a lot of market variation. So this is making office sort of the new retail, because shopping centers and brick and mortar retail over the last 10 years was basically facing a shock from e-commerce. It has reinvented itself and repositioned itself. So retail is now actually, ironically, doing very well, while office properties struggle more than any other product type.
Yeah, Sam, it's been interesting to see the strength that we have been seeing in retail. What do you think is behind that? And also, when we talk about retail, what about the industrial side of the retail story? How does that look at this point?
You know, what has brought retail back is a lack of new construction for the last 10 plus years, because retail was so overbuilt and so much obsolescence was coming to market that there had to be different uses for lots of retail properties and different re-tenanting. And what really brought retail back was the experiential retail type of format with food, fitness, health, and beauty related activities, and of course, entertainment. That was quite strong pre-pandemic. It was devastated during the pandemic and has come back roaring since then because of pent-up demand on the consumer side. With office buildings, it's going to be much harder to reposition them, or in fact, even knock them down and repurpose them. Conversion of office to multifamily is another very strong sector, is somewhat of an opportunity, but it's very expensive. And so the question is still out there as to what will happen to excess office space, especially older office buildings that aren't as compelling as the newer ones. On the industrial front, ironically, e-commerce has created a whole new wave of warehousing and distribution facility needs that are modern and have just-in-time kind of inventory management and transportation links. So industrial has been doing extremely well, primarily because of e-commerce.
Specifically on retail, we have seen these mixed use cases pop up more and more. You know, these large areas that were left vacant because a department store like JCPenney closed down. You know, what do you do with that? We've seen apartments moving in. How much of that model do you see picking up? Because if you're looking at the residential side of things, we are still seeing it pretty limited in terms of inventory.
You're absolutely right. Multifamily in particular is doing extremely well. Occupancies are down a little bit year over year, but still around 95%. And there's a lot of buzz around overbuilding 400,000 or so apartment units this year. But if you look under the hood, those 400,000 units are really concentrated in about 10 major markets. The rest of the country is sharing 200,000 units of new apartment rentals, which is a rounding error. We have a housing shortage in this country that's acute. And with interest rates having gone up and home prices having gone up so much, there's even less affordability and more demand for apartment rentals. There is a shortage of inventory outside of those 10 metros. And by the way, those 10 metros are like Atlanta, Dallas, Austin, Phoenix, that tend to have a lot of growth, but sometimes they get ahead of themselves and build too many units. Overall, multifamily is performing very well, and the housing shortage is actually helping the demand stay very strong.
Sam Naji, always great to get your perspective, CEO of Marcus & Millichap. Thanks so much.
Well, shares of Walmart closed higher today in the session after Q1 earnings came in stronger than expected. Our morning team caught up with Walmart CFO John David Rainey to discuss the latest quarter. Take a listen.
We had a really strong quarter. We're pleased that revenue, our top line, was able to grow over 7%. But I think very importantly, we saw that our operating income grew at 17%. And what this demonstrates is that the value proposition, our value proposition, is really resonating with customers. But we continue to see, as you noted, a mix shift in our business. As consumer wallets are stretched more thinly, they're shifting more of their dollars to purchasing items like food and consumables and less away from general merchandise. And overall, that does have an impact on our business because general merchandise tends to be higher margin for us. But even despite that, we were able to grow operating income in the quarter 17% and increased our guidance for the year as well.
John David, Brian here. Good to get some time with you. You mentioned on the analyst call this morning that sales moderated as the quarter progressed. Why do you think that was the case? And then bigger picture, how financially stressed is the core U.S. shopper at Walmart?
Yeah, the moderation did occur in the quarter, and there's a couple reasons, Brian, to point to. I think one is just headline inflation rates are coming down. That affects our revenue numbers as well. We're beginning to lap some of those periods of higher inflation last year. But there were also a couple key trends in the quarter that affected our business and the macro economy at large. And so one of those I'd point to is SNAP benefits. Those abated during the quarter, and that we tend to see that spending patterns follow that as well. We also saw overall for the quarter a reduction in year-over-year tax refunds. And the way that played out in the quarter, earlier in the quarter, we were seeing increases in year-over-year tax refunds. For the quarter in total, it was down 10 or 11%. And again, spending trends followed that. And then lastly, and this was a good guy for us, but we saw an increase related to the cost of living adjustment with Social Security. And that happened earlier in the quarter. And so all these things combined kind of impacted the cadence of revenue growth in the quarter. And so February started off really strong, and then we saw a little bit of a drop down in March and April.
John David, Brad here. Would love to know in terms of the digital and the e-commerce business, and you've invested so much into that over the past 7 to 10 years, and it's really paying off here over time. I'm just wondering, as you think about further investment into that technological touch point with your end consumer, how you're seeing some of the members of your rewards program or those that are kind of closest to Walmart as a subscriber base, how they're continuing to engage with the brand and where they're even continuing to spend on an average basis, if there's any figures that kind of have been elucidated over that time in the investment in technology.
Sure. Well, our e-commerce business was up 26% in the quarter, and I feel like we're really hitting our stride here. Our value proposition is resonating, but it's not just around price. It's also around convenience, and that matters irrespective of what your income level is. And so things like online pickup and delivery continue to grow at much faster rates than the rest of our business. And when you have value like that, when we provide value like that to our customers, you're willing to subscribe to a membership where you have the utility in that. And what we see among those members is that about 50% of them actually come from the channel of online pickup and delivery. And the spending related to that they are appreciably higher than what an average Walmart customer is. So we want more people to avail themselves of the suite of benefits that we provide for our customers.
John David, how concerned are you that you guys mentioned on the earnings release, still seeing double-digit food inflation? Now, we have gotten a series of rate hikes over the past year and a half. Supply chains have improved, but we're still hearing from Walmart double-digit inflation. What's causing this, and any relief in sight?
Sure. Well, our guidance for the year really has sort of finely balances a cautious outlook on the consumer with some conviction in our own ability to execute on our strategy. But you're exactly right. If you look at the headline numbers, sure, inflation is coming down because we're lapping higher prices last year. But if you're a consumer going to buy a basket of groceries, prices are still high. If you look at food prices on a 2-year stack basis, they're still up 20%. And so pocketbooks are pinched, and that's causing customers to be more discretionary with these larger ticket items like electronics, TVs, home, and apparel.
You said on the call that you are seeing signs of stress on consumers below the surface. Is that the kind of thing that you're talking about? What else can you tell us about those signs of stress?
Yeah, it's the same thing that we saw in the prior couple quarters as well. When consumers are coming to our stores, we're seeing trade downs in terms of buying less expensive meats, or instead of buying a pack of 12, they're buying a pack of 6. You can see that their wallets are being stretched more thinly. And when you look broadly, I look at the same economic data that you do, but there are other indicators. We're seeing credit as a funding instrument, as an example, be more elevated to where it was in prior periods. You're seeing delinquency rates on credit cards in general tick up. And so there are these signs that there's some fraying in terms of the consumer health, and we're keeping a cautious outlook on that. There's a lot that we don't know about the back half of the year, and we want to be prepared for any type of economic environment.
John David, we've heard some of your competitors, Target, some of the pharmacy store chains as well, have talked a lot about what you in the retail industry call shrink, which sometimes is a euphemism for theft. It seems like some of it is organized crime coming into the stores, stealing lots of stuff. What are you seeing at Walmart? And to you, is that also a sign of the times and economic stress, or is there something else going on there?
Yeah, well, I certainly think it's related, but to be clear, this is a problem for all retailers. But our main focus at Walmart is protecting our associates, protecting our customers, but also protecting our merchandise. But this is not an issue that one retailer or either the retailers at large can solve by themselves. We need engagement from the local communities to help solve this.
John Dave, of course, Walmart is very much an international company, and one slide that stood out to me in your presentation is China. Some very big sales growth numbers there. What is driving that, and what is the outlook for your China business in the back half of the year?
One of the things that I love about our China business is how penetrated we are into e-commerce. That business is roughly 50-50 in terms of brick and mortar versus e-commerce. And I think it's a great indication of how to think about our business at an enterprise level into the future. But you're right, China was a real bright spot for us in the quarter. A part of that was the economy reopening, but we also our team did a very good job making sure that we had the right merchandise in the right place to respond to the seasonal demand earlier in the quarter. So really pleased with the progress that we saw there, not only from a top line perspective, but bottom line as well.
That was Walmart CFO John David Rainey speaking to our morning team.
FDA advisors are voting on Pfizer's experimental maternal RSV vaccine. Here with the latest is Yahoo Finance health reporter Anjali Khemlani. Anji, you've been listening in. You just pulled your earbuds out. What are we hearing?
We just got the vote in. So hot off the press, we got a majority of the votes in for the Pfizer's maternal RSV vaccine, and that's 14-0 a vote on approving it or recommending approval based on the efficacy of the vaccine. But we did get a 10-4 vote on voting for on recommendation on the safety profile of the vaccine. I'm going to get to that in just a second, but just to recap what we're looking at with Pfizer's vaccine, it is a 120 microgram dose administered to pregnant mothers between the weeks of 24 to 36 weeks. It protects the baby up to 6 months. That's at least the endpoint that they had notified, and it met that endpoint. We noted that in the data, number one, that later in the third trimester is when it seemed to have the best efficacy, as well as strongest protection up to 30 days versus after that. Now, Pfizer is competing with GlaxoSmithKline for RSV vaccines. We did note specifically that GSK actually dropped out or paused their phase 3 because of certain safety signals, which you can see, of course, indicated in those votes there. Specifically on preterm births, Pfizer noted 5.6% in their vaccine group versus 4.7% in placebo. GlaxoSmithKline noted noted 6.8% in their vaccine group versus 4.9% in placebo. So the placebo numbers are pretty close. They also do have some similar indications. One major difference is that GlaxoSmithKline's group also had neonatal deaths reported. So that was a significant safety signal as well. And that's what started that pause. So as it stands right now, Pfizer looks like it's clear for at least a recommendation for a yes vote from the FDA. They are still waiting on the FDA to decide on their older adult vaccine for RSV. They also do have that up for waiting for a vote from the FDA. Meanwhile, GlaxoSmithKline was the first to get the 60 and older RSV vaccine out. So neck and neck, really, when it comes to it. But Pfizer is the only one on the table right now with a maternal vaccine. So if this moves forward, it'll be the first.
We will continue to watch that. Anj, thanks so much. Well, coming up, we will get you caught up on some of the trending tickers moving after hours. Stick around. Let's take a look at what's trending after hours. You got three names for you. Kicking it off with Raw Stores, the company, the off-price retailer, just reporting its earnings results. You're looking at shares under a bit of pressure here in after hours trading. Now for Q1, their sales did rise, but their outlook was muted, and that's what's really putting pressure on the stock in extended trading. Some progress here on their inventory levels. Q1 same-store sales were up about 1%, but the company does expect its full year same-store sales to be flat. Also some commentary here from the CEO of Barbara Rentler in this earnings release, saying that high-level uncertainty of macroeconomic and geopolitical environments continuing to weigh on the company. Also inflation impacting their lower income consumer. We're looking at losses of just about 0.5% year to date. Taking a look at the performance of the retailer, off nearly 10%. Take a look at Applied Materials, the play within the chip space. That's off just over 1% right now. The company did beat on EPS. Sales coming in slightly better than expected. Demand for chips, though, is really causing some weakness here for the company. Looking forward, the company guiding a sales drop for the third quarter. Not as bad as the street had initially feared, but still, they do expect to see a drop in their sales for the current quarter. Right now, we're looking at losses of just about 1.5%. And rounding it out with the Disney, the company just releasing here right before the bell, they plan to close their very costly Star Wars hotel in September. Remember that this just opened within a couple of years ago. It's very, very costly, though, experience. It could cost just around $1,200 per person per day. For a family package, it's around $6,000. The company saying that it does plan to close the Star Wars hotel. Also news earlier today that Disney is scrapping its $1 billion office complex plans there in Florida amid the ongoing feud between Disney CEO Bob Iger and Florida Governor Ron DeSantis. So Disney, a name to keep your eye on in tomorrow's trading.
Well, it's closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. Walmart reported its first quarter results, topping analyst estimates. The retail giant also raised its full-year forecast. Walmart benefited from wealthier consumers trading down as inflation continues to pinch wallets. Walmart shares ended the day slightly higher, up about 1.3%.
We also got a couple of key pieces of housing data today. First up, April existing home sales falling 3.4% from March, while median home prices fell 1.7% from a year ago. That's according to the National Association of Realtors. Meanwhile, Freddie Mac mortgage rate data showing that the 30-year mortgage rates ticked slightly higher, increasing to 6.39% this week from 6.35% the week prior.
And finally, Disney says it is canceling plans to move thousands of employees from California to Florida amid the company's feud with Florida Governor Ron DeSantis. According to an internal memo obtained by Yahoo Finance, the head of Disney Park cites changes, including new leadership and changing business conditions for the cancellation.
All right, well, that does it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell. We'll see you tomorrow.